Ben and Jennifer retired 10 years ago in Michigan. They had $500,000 saved. Every dollar sat in dividend and bond funds. Safe, steady, no drama. They pulled $50,000 a year to live on, never touched the stock market, never lost a dime. But here's what they didn't see coming. That $50,000 today, it buys what $37,000 bought when they retired. Groceries cost more, insurance costs more, property taxes went up, their income stayed flat. They didn't lose money in a crash. Inflation quietly ate 26% of their buying power, and they never even felt it happening. Here's the hard number. A Wharton study tracked every major asset class going back over 200 years. $10,000 in bonds over 30 years grows to about $28,800 in real purchasing power. That same $10,000 in stocks, roughly $67,700. That's a $38,900 gap on just $10,000. Now, scale that up to a real retirement portfolio. And here's why this matters more than ever. JP Morgan's 2026 retirement guide says a 65-year-old couple has a 47% chance that at least one of them lives to 90. This isn't a 10-year plan, it's a 25 to 30-year plan. Without growth in your portfolio, the math doesn't survive that long. By the end of this video, you'll know the 3 beliefs that are quietly draining your retirement and the framework that smart retirees use to fix it. And the 3rd belief? Financial advisors have been teaching it for decades. Turns out, the research says they had it backwards. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Myth number 1, your dividends are free money. So let's start with the belief almost every retiree holds. And I get it, I understand why people believe this. Here's the myth. I live off my dividends and never touch my principal. That's the safe way to retire. It sounds perfect. Money shows up in your account, you spend it, your shares stay the same. Free income, right? Not exactly. A major study from the University of Chicago looked at how investors think about dividends. Here's what they found. When a company pays you a $1 dividend, the share price drops by about $1. That dollar didn't appear from nowhere. It came out of your investment. Think about it like this. You have a $100 bill. You break it into a $99 bill and a $1 bill. You didn't make a dollar, you just moved it from one pocket to another. Except now the IRS wants a cut of that dollar. That's exactly what a dividend is. It's your own money coming back to you with a tax bill attached. And here's where it gets expensive. When everyone crowds into dividend stocks at the same time, and they do, especially when interest rates are low, those stocks get overpriced. The research found that dividend-chasing investors earned 2 to 4% less per year than they otherwise would have. On a $500,000 portfolio, that's $10,000 to $20,000 a year left on the table. Here's the truth. Dividends aren't free income. They're a forced withdrawal on someone else's schedule. Smart retirees choose when to take their money. They sell a few shares of a growth fund when they need cash. They pick the timing. They pick the tax year. And for many retirees, those gains fall in the 0% long-term capital gains bracket. Same cash in your pocket, more control, less tax. So if living off dividends isn't the safe path everyone thinks it is, what about the other thing most retirees believe, that owning lots of different funds means you're diversified? Here's where it gets uncomfortable.
Myth number 2. More ETFs equals more diversification. Here's the myth. I own 4 different growth ETFs. I'm well diversified. 4 fund names on your screen, 4 different logos, 4 different expense ratios. It feels diversified. But what if I told you those 4 funds are mostly the same stocks wearing different uniforms? Let's look at a popular combination: VOO, VGT, QQQM, and SCHD. 4 funds sound spread out. But when you check what's actually inside these funds, the picture changes fast. QQQM, the NASDAQ 100 fund, shares 87% of its holdings with VOO. 87%. That means almost 9 out of every 10 stocks in QQQM are already in VOO. Now add VGT. It correlates with QQQM at 0.94 out of 1. That's almost a perfect mirror. And here's the gut punch. Nvidia, Apple, and Microsoft appear in 3 of those 4 funds. You're not spreading risk across 4 investments. You're tripling down on the same 10 mega-cap tech names through 3 different wrappers. You're paying 3 expense ratios for what is basically 1 bet. The 2022 bear market proved it. All 3 funds dropped in lockstep. Investors who thought they were diversified watched everything fall at once. Now, what about SCHD? That's actually the one fund that's different. It holds dividend-paying value companies, almost zero overlap with the tech-heavy trio. But here's the problem. SCHD isn't a growth fund. In March 2024, its index dropped Broadcom, right before that stock doubled on AI demand. SCHD returned about 4% in 2024. VOO returned nearly 18%. That's a 13-point gap. SCHD does great work, just not in the growth bucket. It belongs in your income bucket, doing what it was designed to do. Here's the truth. 4 fund names doesn't mean 4 different bets. Smart retirees check what's inside, and most of the time, 2 focused funds beat 4 overlapping ones. Before we get to the third myth, and this one is going to surprise you, drop a comment right now. How many growth ETFs are in your retirement portfolio? 0, 1, 4? I read every single comment and I want to know where you stand. Now, remember I said one of these myths is something financial advisors have told you for decades? This is it, and the academic research says the opposite is true. Myth number 3, you should get safer as you age. Here's the myth. I'm retired. I should keep getting more conservative every year. Less stock, more bonds, play it safe. You've heard this 1,000 times, and it makes sense on the surface. You're not earning a paycheck anymore, you can't afford big losses, so pull back from stocks and load up on bonds. But 2 respected researchers, Wade Pfau and Michael Kitces, tested this idea against the actual data, and what they found will surprise you. A rising equity glide path, where you start retirement with less in stocks and gradually move more into stocks as you age, actually reduces your chance of running out of money. Read that again. More stocks over time, not less, and it works better. Here's why. The biggest danger to your portfolio isn't a market crash in year 15. It's a crash in year 1 or year 2, right after you retire. That's called sequence of returns risk. A bad market when your portfolio is at its largest forces you to sell at the worst prices. So what do smart retirees do? They keep their growth bucket untouched in those early years. They spend from their income and foundation buckets first, and they let the growth bucket compound. By the time they tap into growth, 10, 15, 20 years later, it's had time to ride out any downturn and multiply. And here's the best part. If you already use a bucket strategy, you're halfway there. Kitces himself said the bucket approach is the most natural way to create a rising equity glide path. You don't need a complicated formula. You just need to spend your buckets in the right order. And here's more data to back this up. Morningstar's 2025 retirement income study found that the highest safe withdrawal rate, 3.9%, came from portfolios with 30 to 50% in stocks. Portfolios under 30% stocks actually had a lower safe withdrawal rate. Less stock didn't make them safer, it made them weaker.
One more thing. Research on retirement spending shows something most people don't expect. Real spending actually drops about 26% by age 84. You spend less as you get older, not more. That means your growth bucket has even more time to compound before you ever need it. Here's the truth. The research doesn't say get safer. It says start safe, then let your growth bucket do its job. The bucket strategy you already understand? It's the rising glide path in disguise. Growth isn't gambling in retirement. No growth, that's the real gamble. So now you know what's really costing you. The question is, what does the fix actually look like? Here's the framework. The growth blueprint. Step 1. Consolidate. Don't own 4 funds that hold the same stocks. Pick one broad market fund like VO or QQQM, not both. Then add one fund that actually gives you something different, a sector tilt, a factor fund, something with low overlap. Before you buy anything, check the overlap. There's a free tool at ETF Research Center where you type in 2 tickers and see exactly how much they share. If it's above 50%, you're paying 2 expense ratios for 1 bet. Step 2. Put growth in the right bucket. Your growth allocation goes in the bucket you spend last, not first, not second, last. That's how you create the rising equity glide path without even thinking about it. Your income bucket covers today's bills. Your foundation bucket is your safety net. Your growth bucket sits and compounds for 10, 15, 20 years. Step 3. Use trim and transfer, not yield chasing. When you finally need cash from your growth bucket, sell a few shares. You choose the timing, you choose the tax year. For many retirees, long-term capital gains fall in the 0% bracket. Dividends get taxed every year whether you want the cash or not. Selling appreciated shares puts you in control. Step 4. Harvest your losses in taxable accounts. When the market dips, and it will, use that dip. Sell the fund at a loss, buy a similar but not identical fund, and bank the tax deduction. Vanguard's research shows this adds between 0.47% and 1.27% in extra after-tax returns per year. Over a decade, that's real money. Step 5. Check the growth bucket once a year. Not once a week, not once a day, once a year. Nobel Prize-winning research from Benartzi and Thaler found that investors who check less frequently make better decisions. They hold more stocks, they earn more over time. Checking every day triggers the fear response. Checking once a year lets compounding do its work. Here's the math that brings it home. At roughly 15% annual return, which is VO's 10-year track record, the rule of 72 says your money doubles in under 5 years. In a high-yield savings account at 4%, doubling takes 18 years. Put $100,000 in each. After 15 years, the growth bucket holds roughly $813,000. The savings account holds about $180,000. That's a $630,000 gap on one single allocation decision. That's the real cost of ignoring growth. If someone you care about is sitting in an all-income portfolio right now with 0 growth, send them this video. It could save them tens of thousands over the next decade. Tell me in the comments, after watching this, are you going to add a growth bucket or change the one you already have? I want to hear your plan. If you're building retirement income and want to stay ahead of the mistakes most people never see coming, subscribe to this channel. I break down everything that protects your money. Next video, I'm breaking down the exact overlap numbers between the 10 most popular retirement ETFs. Some of the combinations people are running will shock you.